Hello, dear students. I hope that you guys are doing great and I hope that your preparation is also going well up till now. Everything that we have covered up with an audit risk is something that you have done, you have remembered it, and you will use it within your exam questions as well. As I repeated within the previous lecture as well, this is going to be a lecture where we will be moving towards solving the exam questions of audit risk. How to solve the exam questions is something that we have already discussed within the previous lecture. If you haven't taken that lecture, then I would request you to go and first take that lecture. But in a summary, this is the way that you follow. This is the type, this is the format that you always follow, the table that you always follow whenever you identify a risk within the question and how you have to explain it. On the audit, you first of all, again, let me just recap a bit for you. First, you have to make a table within your answer. On one side, you will always write down the heading audit risk. On the other side, you will write down the heading auditor's response. Whenever you identify that there is a risky area within the financial statements from the question that is given to you, you will write about it in 4 different paragraphs, always mentioning about the 4 different points. Then you will always come towards auditor's response. When we talk about auditor's response, the fourth point in the audit risk area is something where you explained what was going on in your mind when you identified this risk from within the question, or in short form, why did you think that this area within the financial statements is a risk. Now, how is the audit team going to verify whether what you thought is it correct or not? You thought that there would be an overstatement in revenue, there you thought that there would be an understatement within assets, and so on and so forth. How will you let an audit team know what do they have to do to verify whether what you are thinking is it correct or not? An easy way to write a response is to always imagine that within the exam you are either an audit manager, a senior manager, or a director within the audit firm, and now you have to let the audit team know that this is the risky area that I've identified from the scenario, and now what will you have to do? What things can you do to verify whether what I am thinking is it correct or not correct? I told you that these are some of the things that you can write down within your answers, but always make sure that you write down your answers in such a way that the examiner sees that you are addressing your audit team. Now, coming towards the next thing, I told you that there are a few examples which I've written here. I told you guys to please try to do these yourselves, and once you have done it, share your answers with me so that I can check it and let you know whether you have done it properly or not. This is something that you had to do as a homework. But after that, I also went towards some of the example risks that I have written down here, and I told you that these are the risks that you will always see are repeating within the Kaplan kit, and the same risks are the ones that you will also see that they will repeat within your practical exam as well. When you go to AA exam, you will see that the same types of risks are arising within the questions. So it will be a lot easier for you if you had read it before this lecture, because then you will be able to understand what we are doing within this question. A lot of the areas which we read within our question today, you will easily be able to identify them if you have already just read through these, not learn them, just read through these. Now, coming towards our exam kit, always remember, we will always use this format to solve down our answers, to always write down our answers. We will always use this technique within the exam. Coming towards the exam kit, within the exam kit, the first question that we are going to attempt in this lecture is going to be green corporation. Now, as this is the first question of audit risk that we will be doing, I'll be solving every single thing on Word file. That Word file will also be shared to you guys so that you guys can use it later on to understand how I have written down the risky areas. Now, before reading the question, first let's read the requirements. Before reading the scenario, let's read the requirements first of all. If I come towards the requirements, requirement number A is describe 8 audit risks and explain the auditor's response to each risk in planning the audit of green corporation. Now, as I repeated within the previous lecture as well, audit risk identification, identifying which areas within the financial statements are at a higher risk, this is done at the planning stage. And normally from the within the firm, within the audit team, the most senior person within the audit team, either a director, a senior manager, or a manager, does it. He identifies from the financial statements which would have which areas or which financial line items are going to have a lot of risks in them, and then he tells the audit team what do they have to do. So the same thing is what is tested within the exam as well. As a manager, you will have to identify what are the risky areas, and then you will have to let the team know what do they have to do in order to make sure whether the risk exists or not, whether they are overstatements or understatements within the financial statements or not. Now, this question is for 16 marks, and I told you within the previous lecture that every single risk that you identify, write down within the audit risk section, and every single response you give to it. For each, you will get 1 mark. So this means in total for one risk, you will have 2 marks. So 16 divided by 2, again, you will have to write down in simple word 8 audit risks. And the examiner has also mentioned that you will have to write down 8 audit risks. Let's move towards the question. But before moving towards the question, let's read the remaining parts. Can we attempt them at the moment or not? So part B is explain the responsibility of Teal Incorporation. This is the auditor under ISA 250, consideration of laws and regulations in an audit of financial statements. So the question is asking what are the responsibilities of the auditor in relation to laws and regulations when they are doing an audit. Right now, we haven't gone through that area of the syllabus, so we can skip it at the moment. Part C, substantive procedures is something that you haven't done at the moment. We can skip this as well. Quality management is something that we will cover up within the next chapter. Right now, we can't do the answer as well, so we can skip it as well. After this, there is a new question, so let's move towards the question and let's start reading the question overall. So, as we have done within the previous questions as well, which we have solved within these lectures, first we will read every single paragraph, identify the risky areas, and mark them down within our answer. After then, we will move towards writing down our answer. So, the question name is Green Corporation. Let's read the requirement. The scenario relates to 4 requirements. All right, we know what the 4 requirements are, A, B, C, and D, but we will only be solving part number A. All of the question is linked to part number A. By the way, whenever we talk about audit risk, any specific part will not only be linked to audit risk. No, you cannot do that. In the case of ethics, in the case of code of corporate governance, a specific paragraph will be given to you, or a specific paragraph from within the scenario can be linked with CCG or ethics. But when we talk about audit risk, you will have to read all of the question. Every single line you will have to read it, because there can be a risk in any single thing that is given to you. Now, I told you within the previous lecture that the examiner can test audit risk in 3 different forms. In 3 different ways the examiner can test it. Either he will simply give you the financial statements. You will have to perform analytical procedures upon the financial statements, which we have covered within the lectures. And then you will have to identify from the analytical procedures using the relationships between different financial statement line items, like loan is linked with interest. So if the loan is increasing and the interest cost is decreasing, there is a risk there. That is one way the examiner can test audit risk questions within the exam. There is a very less chance that the examiner may test it only through this one. No, the examiner will not do it. There is a very less chance. The second way is that the examiner will only give you the scenario, the story. And reading the story, you will have to identify in which areas of the financial statements is there a risk or not. I told you that normally what happens within practical life as well is that first you perform analytical procedures, you identify high risky areas, then you discuss with the management. The responses of the management, the answers of the management are noted down by the auditor. And then the auditor goes back to his room and reads those responses and tries to identify risky areas within financial statements from within those responses as well. But again, individually testing directly from the story is also a very less chance. The examiner has a high chance compared to only giving you the financial statements. The examiner has a high chance that he may only give you the story. But again, there is a very less chance. But the highest chance is that the examiner may test both of the things combined. The examiner may test both of the things combined. He will also give you the financial statements, and he might also give you a story. And using both of them, you will have to identify risky areas within the financial statements. So if I come towards this question, what sort of question is this? We can see that the scenario is given to us. All of this is the story, the scenario. But if I come down, the examiner, instead of giving me the financial statements and me myself performing analytical procedures, the examiner has performed the analytical procedures for me. He has calculated every single thing for me, and he has given me 3 different calculations. Now, this is a sort of combined situation as well, where you are given analytical procedures and the story, and using both of these, you will have to identify where the risk lies. First of all, your goal must be that you always see the analytical procedures, because anywhere in the question, the calculations you have done can be linked with the scenario, but scenario cannot be linked with analytical procedures. First of all, always look at the analytical procedure. So if I see here, the gross profit margin of the company, revenue minus cost of sales is equal to gross profit. So the gross profit margin, gross profit divided by revenue multiplied by 100 is gross profit margin. For this year, which we are auditing at the moment, it is 26%. In the previous year, it was 20%. So the gross profit margin has gone up. Why would it go up? Either the revenue of the company has increased or either the cost of sales has decreased. Either way, cost of sales and revenue are directly linked with each other. An increase in revenue must, let's say, an increase in revenue of 16%, cost of sales is directly linked with associated with revenue. Hence, there must also be a 16% increase within cost of sales. So, hypothetically, theoretically, gross profit margin of the company should remain same. It shouldn't fluctuate too much. 6% fluctuation is also too much fluctuation. But straightforward, using the analytical procedures, when a story has also been given to me, I cannot create a risk directly from that. I will never create a risk directly from the analytical procedures if a story has been given to me, because this means that I'm trying to create procedures, trying to create my answers out of thin air. Examiner will never give you scores, give you marks for things that you have written down and created out of thin air. No, the examiner will not do that. So the next type of calculation that has been given to me is operating profit margin. So operating profit is profit for the year. All the expenses minus profit after tax is known as profit for the year. So profit for the year divided by revenue multiplied by 100 is operating profit. No, sorry, this is not net profit margin. I was telling you the ratio for net profit margin. Apologies. Operating profit means profit before finance, interest cost and tax is known as operating profit margin. If I have to show you operating profit, let me come towards my financial statements that I created. In this, profit before tax is not known as operating profit margin. Here, if I draw a line here and gross profit minus 100 minus 300, so all of the directly attributable expenses and calculate what is the profit here, this would be known as operating profit margin. So operating profit margin has been given to us. This year, which we are auditing, it is 7%. In the previous year, it was 11%. So the operating profit margin is decreasing, whereas the gross profit margin is increasing. This gives us a story. The story that it shows us is that revenue cost of sales has increased, whereas the expenses that comes after the cost of sales, they have increased. Revenue has also increased. The cost of sales has decreased. The expense that is before gross profit is what? The expense that is before the gross profit is only cost of sales. This has decreased, because of which the gross profit of the company has increased. But when we come towards these expenses, these have increased. That is why the net profit margin, the operating profit margin of the company is decreasing, whereas the gross profit is increasing. There is always a risk when this is the case. When gross profit and operating profit or net profit are not matching with each other, they should match. The percentage increase in this should also be a percentage almost equal to the previous year. They should almost be equal to the previous year. Because if we see that on one side, this is increasing, on one side, this is increasing, this means these expenses are decreasing. On the other side, these expenses are increasing. This means that some of these expenses which should have been written here might have been recorded here by the company, because of which these expenses are increasing more, whereas the cost of sales is decreasing. Which is why the gross profit would increase during the year, which is why the operating profit would decrease during the year. So if these expenses are increasing, whereas cost of sales is decreasing, this always gives us a picture that management may have incorrectly recorded these expenses here, because of which these expenses increased during the year, because of which the operating profit decreased and the gross profit margin increased for the company. But we are simply not going to create a risk for now. This doesn't mean that there is a risk. We will see, can we create this risk or not? Because there might be a chance that gross profit, operating profit, a scenario linked to these two might be given within the story that has been given to us. So we are not directly going to create a risk right now. Receivable collection period. When we talk about receivables in the current year, which we are auditing, the receivable days is 67 days. This means that our customers, when they buy things from us, compared to when they pay us the money for the things that they have bought from us. It takes them 67 days to pay us that money. But in the previous year, they were paying us within 40 days. They were only taking 40 days to make the payment to us. This means that a lot of the customers are taking a lot of time to pay us back, which creates a situation that there might be receivables who may not be able to pay you back because they may be facing financial difficulties, which is why your receivable collection period has increased, your receivable days has increased. This creates a risk that your receivables might be overstated and the bad debt expense, allowance for receivable expense, might be understated within financial statements. I have these risks within my mind. One risk that I've created here, a classification error that the management might have done. Classification means that management had to record something elsewhere, they recorded it somewhere else. This means they have not classified the thing properly. Secondly, there is an overstated receivable risk in this case as well. But first, let's move towards the story. Let's read the story. Moving towards the scenario that is given to us, let's read it. Let's try to identify audit risks, risky areas within the financial statements, or where we might not be able to identify risky areas within the financial statements, because audit risk is based upon two things: ROMM, risk of material misstatement. In my notes, if I come towards that, I have written it down here. No, not here. I have written it down here. So, audit risk is based upon two things: ROMM, that there would be, number one, ROMM, that there would be errors within the financial statement because of two different reasons, either inherent risk or control risk. And the number two was detection risk, which the auditor controls. So detection risk means that because of any reason, the auditor may not be able to identify risky areas or material misstatements within the financial statement. So let's read the scenario. The question again demands us to identify audit risks. Let's read the question. Green Corporation. It is 1st of July 2015. Let me highlight this date. What is the date today? Let me highlight it first of all. So it is 1st of July. Give me a second. Let me pull out my highlighter. So leave the highlighter for now, but just read this. It is 1st of July 2015. This date is very important to you because this tells you what is the date today, because you need to know what is the date today. Let's read forward. You are an audit supervisor with Teal and Corporation. So basically, my position within the audit firm is audit supervisor, and I work within the audit firm. The name of the audit firm is Teal and Co. This is the name of the audit firm. Great. Not important for me during identification of audit risk, but overall, I need to know what the question is demanding. Which has recently been appointed as auditors of Green Corporation. Okay, so the first line, there is a risk here. Now, when I asked you to read these different examples of risk, the first risk that was written here, having a new audit client. Whenever it is the first year, this is the first time that this audit firm is auditing a company. You may have been auditing multiple different companies a year ago, 2 years ago, or for your lifetime of the firm. You may have been auditing multiple different companies. But whenever, let's say, Gohar Zeb Shah Corporation is a company that came to you, asked you that you have to audit my company, and this is the first year that you will be auditing my company, there is always a risk. And the risk is related to the auditor himself. Because imagine, you become friends with someone new, someone who you don't know right now. It is your first time going out with them, going on a dinner with them, whatever you want to think of. But if he's your new friend, would you trust him? Or if I ask about trust, how would you talk to that person? Would you be in your normal personality, in the way you normally talk with someone, would you talk like that? Or more probably, you would be more, let's say, sophisticated. You would be more trying to be a good person. Now, just like the example of your friend, whenever an auditor has a new audit client, a company that he doesn't have a lot of experience in auditing, he doesn't know anything about that company. What did I say? He doesn't know anything about that company. This shows that there may be a lot of things that he doesn't know right now about that company, because it is their new audit client. They have no understanding of the company, because of which there may be many different issues within the financial statements, and as they have no experience with this company, They may not be able to identify those misstatements in the financial statements. See, identification of misstatements doesn't mean an auditor. When you are an auditor, it doesn't mean that you can simply go out to audit a company and you will automatically identify. You will have such a high sense of understanding financial statements that you will simply identify by looking at the financial statements which areas have a higher risk. As an auditor, whenever it is your new audit client, auditor is also a human being. He can also make a lot of errors. Because when you have been auditing a company, let's say for the past year you audited them, for the last 10 years you have been auditing the same company, that audit firm will have a lot of experience working with that audit client. They will know what sort of mistakes this company can make, what controls are weak within this company, what complex calculations they have to do within the financial statements, because of which there will be a lot of risk in the financial statement in a specific line item. But when you are auditing a company that is completely new to you, an audit firm gets a new audit client, that audit firm has no experience with that client, because of which they may not be able to understand a lot of the things of the company, complex calculations, so on and so forth. How do they do their accounting calculations? And they may not be able to identify material misstatements within the financial statements. Now, when an auditor is not able to identify material misstatements within the financial statements because of any reason, either sampling risk or non-sampling risk, it is known as detection risk. So in this specific line, this one, in this specific line, this is a detection risk included within the audit risk. So this will give us scores if we write down about it using our answer format, this format. If we use this format and write down about this, identify this, this will automatically give us scores. Now, let's read forward right now. Obviously, we will go towards writing every single thing down, but once we identify every single risk that is hidden within this question, let's read further on. So, and you are planning your first audit, which will be for the year ending 31st of July 2015. So, this date is also very important to me as an auditor, because this tells me what is their year end, on which date they would make the financial statements and give it to us. Now, a lot of you might be confused that, sir, please look at the current date. It is not even the year end right now. It is 1 month before the year end. We don't even have the financial statements. How will we start auditing the company? Planning of the audit starts. Planning means identification of risky areas within financial statements, so on and so forth. This starts 1 or 2 months before the year end has actually happened. So, Green Corporation. Now, further on, the examiner is telling us what is the business of this company. Green Corporation sells a variety of plants, garden equipment, and garden furniture to wholesale customers and to retail customers as well via network of stores. So basically, they have different stores within different cities in the country that they do business in, and within these stores, they sell garden equipment, plants, and basically gardening equipment is the things that they sold, and outside furniture is sold by this company to variety of different types of customers. Okay, they have a great business. Customers, where were we? Here. The company was formed 13 years ago by Aidan White. So Aidan White is the person who made this company, who founded this company, who is the chief executive officer of the company. Now, a lot of you students might create a risk here that why is the owner also the chief executive director? This is not a CCG question, even though, first of all, it is not a listed company. Nowhere it has mentioned that this is a listed company. Even though it was a listed company, you cannot create this risk here that why is the CEO the owner of the company? According to the code of corporate governance, the owner should not be involved within the decision making of the company. They should select non-executive directors. No, you cannot create this risk here. This is not a code of corporate governance question. This is an audit risk question. There is no audit risk in this case, and is the company's only shareholder. So he owns all of the shares. 100% of the shares are owned by this person, Aidan White. He owns all the shares. Aidan is planning to retire within the next year and is intending to sell his shares in the company. Okay, so this is a huge risk again. Huge risk. Why? There is here in this case, the risk is that because 100% owner of the company is saying that I do not want to run this company anymore and I will retire next year. I will basically is saying that I want to sell my company. Selling his shares means, but first of all, he owns 100% of the company. Then selling his shares, it means that he will sell his business to someone. Now, whenever you want to sell your business, the price of the shares, the price of the business is dependent upon what? The price of the business. What amount should be paid to buy the company from him? The price of the business. It is dependent upon what? I have a question from you guys. Or better yet, I will explain it to you. Price of a company is based upon many different factors, but most probable are two: assets within the company, and number two, the profit of the company or revenue of the company. Looking at the profit, someone, let's say you are going to buy a business. First of all, you will ask them to please give us your financial statements. So you will see the financial statements of that company, and then you will see the first thing that you will want to see is revenue. What is the revenue of this company? Is this company even profitable or not? So you will check out the profit. Then, as an assurance, as an insurance, or as a sure shot cash, assets, all of the assets, if they are sold, how much cash would be received by the company? Let's say this business is not a profitable company. I want to just buy this business for the assets of this company. You are an investor, but you also have a business. You say that after buying this company, I will not run this company. I will close the business down and I will sell every asset of the company. By selling the assets, it would generate money for you. So if the revenue is recorded as a higher amount, if the profit is shown as a higher amount, if the assets are shown as a higher amount, you would be willing to pay more to buy this company, right? The higher the assets, the higher the revenue, the higher the profit, the less the expenses, the less the liabilities. You would be willing to pay more to buy this company. Now, let's come towards the other end. Let's say you are the seller of this company. You know about all of these things, that whoever wants to buy my company, first he will look at the revenue, the expenses, the profits, the assets, the liabilities. Higher the assets, higher the revenue, higher my profit of the company, higher my revenue of the company, lower the expenses of my company, lower the liabilities of my company, I would get a higher price for my company. Now, wouldn't you want to overstate the assets, overstate the revenue, overstate the profit? Wouldn't you want to understate the expenses? Wouldn't you want to understate the liabilities of the company? So overall, now the risk is not, the risk does not belong to any single line item within the financial statements. As I said within my previous lecture as well, these heads, different heads within the financial statements. Where is my financial statement? Here. These different heads are known as single line item in the financial statements. In the case that you are going to sell your company, you would want to understate and overstate many different things in the financial statement, right? So the risk is now not relating to any single one line item. The risk relates to the whole financial statements, that the owner, the CEO, Mr. Aiden White, might try to manipulate the financial statements, overstate the revenues, incomes, and assets of the company, understate the liabilities, expenses of the company, to show a better financial image on the financial statements of the company, so that he can get a better price for his company. Because of which, in this case, the risk is that all of the financial statements may be misstated right now. And we also know why that is the case. So this is the second risk that we have identified within this question. Let's highlight it, let's underline it, and move forward and try to identify the next areas where we think that the risk might exist. So this is the second risk. By the way, how many risks did we have to identify? Only 8 risks. Out of 8, I have already identified 2 risky areas within the financial statements. 2 risks relating to the financial statements. Now I only need to identify 6 more. Let's move forward. The audit engagement partner had a meeting with Aiden White and has advised the audit engagement partner has advised me. Who am I? I'm the audit supervisor within his audit firm. All right. Had advised you of the following. So basically, these are the things that he have told us. All of the paragraphs now here are the things that the audit partner has told me. Let's read them. In August 2014, in which year it would fall? So let's understand it. The year end of this company is 31st of July 2015. So this means that the year would have started from August, 1st of August. 1st of August, previous year, 2024. So if you try to calculate how many months these are, these would be 12 months exactly. So this date falls within my year, within the year that I'm auditing. Let's read it. In August 2014, the company began to refurbish the retail stores in order to incorporate cafes into each one. So the story tells us that from the start of the year that we are auditing at the moment, this company that we are auditing, they basically decided that they want to refurbish the retail stores so that they can include cafes in those stores as well. So every single customer that comes into our store would also look at the cafes, the tea, coffees that will be available, let's say fruit juices that will be available, and they would also buy it. An extra sale for the company, no risk here, no risk here. Some students may state that what if those cafes don't work appropriately? Wouldn't that would be hurtful for the company? That is known as a business risk. This statement would be known as a business risk. We are not identifying business risk in this case. What is hurtful for this company? We are the auditor of this company. We have to identify risk, things that would create misstatements within the financial statements. This wouldn't create, up till now, this wouldn't create any kind of financial statement. So they did this. Let's read forward. Refurbishment cost of 14.2 million were recognized within property, plant and equipment. And this was, okay, let's read it till now, light here. Refurbishment cost of 14.2 million were recognized within property, plant and equipment, and this was partly financed by a loan of 10 million, which is to be repaid in 5 annual installments commencing in September 2015. Let's read it again. There are two hidden risks within this specific line that I've just read, the specific sentence which I've just read. So the first part is that refurbishment cost of 14.2 million, all of the refurbishment costed the company $14.2 million. And all of this money was capitalized. When the examiner says that it was recognized within property, plant and equipment, this means that all of this cost, 14.2 million, was capitalized within the property, plant and equipment. It was not expensed out. Now, under the guidance of IS 16 property, plant and equipment, what does IS 16 state? IS 16 states that only the cost that is capital in nature can be capitalized. Revenue cost or cost that would not increase or enhance the asset itself, it cannot be capitalized. The risk in this case is that the company has capitalized all of this cost. All of it has been capitalized. Nothing has been recorded within statement of profit and loss. The risk is that some of the cost, I'm not saying that all of the cost, some of the cost within $14.2 million might have been revenue in nature, might not have created an extra life for the asset or enhanced the asset itself. That cost should have been expensed out. That should have not been capitalized within property, plant and equipment, whereas the management has capitalized all of the cost. So this is the number 3 risk here. This would do what? This all of, if any of it is revenue expense that should have been expensed out within profit and loss, then this means that right now management has capitalized it. Property, plant and equipment is overstated, whereas the expense that should have been recorded from within this cost, some cost should have been recorded as revenue expense. I'm just creating a risk, a chance that this might be the case. This is what I'm thinking. This might be right. As an auditor, this is what you have to do within your practical life as well. You have to think that from this cost, some might not be actually capitalizable. Some is the cost, some of the cost is something that you might not be allowed under IS 16 to capitalize. You had to expense it out. So if you have capitalized everything, whereas some should have been expensed out, this means property, plant and equipment is overstated in this case, and the expense, the revenue expense that should have been recorded within profit and loss, that has not been recorded. So that is understated in this case. Let's highlight this one as well. This is the third risk that we have identified. Up till here, this is the third risk which we have identified. Now moving forward, what was written ahead? And this was partly financed by a loan of $10 million, which is to be repaid in 5 annual installments commencing in September 2015. The risk in this case is that, first of all, loan calculation itself is a lot complex for the company, which would make misstatements within the financial statements. Errors are inevitable in the calculation of loan because, first of all, loan interest, annual interest, do types of different interest have to be added within loan. Then you find out the actual amount of the loan, what is the closing value of the loan. If you remember from F7 calculations how loan was calculated, then you had to break it between two separate items: current liability of the loan and the non-current liability. Amount that would be paid within 10 months is recorded as current liability. Amount that would be paid after 12 months is recorded as a non-current liability in the loan. So basically, the closing amount of the loan is broken into two pieces: current and non-current. That is the major complex calculation. Again, an error of classification might have happened here, that the management may have recorded all the amounts somewhere, or even though they may have split this $10 million into current and non-current portions. But because this is a complex calculation, they may have made errors in it, because of which there would be misstatement in the amount of current liability and non-current liability. Between the split of the loan, there might be misstatements in this case. So this is the fourth risk that we have created up till now, which is repaid in 5 annual installments commencing in this date. So this is the fourth risk that we have identified right now. Great. And by the way, you all may have a question, sir, how are you identifying these risks? Because I am not getting it in my mind. This is why I told you to read these areas. This is why I told you that from the notes that you have to read these examples of risk that I have given to you, because these are repetitive nature of risk. Every single risk that we have identified up till now, I can guarantee it's already included here. Let's say new audit client. How did we identify it? We created a risk based upon our understanding, but it is already written here. Next off, we identified the risk of someone selling the shares. Okay, that was not written here. It is not in every single question. It was a new risk. Let's come towards this risk: property, plant and equipment, breakup between revenue expense and capital expense. Let me show you that as well. It is written within these notes as well. You see right here. Whenever a cost is capitalized, there is always a risk that within that cost that has been capitalized, there may also exist revenue expense which should have been expensed out, not recorded or not capitalized. It should not have been capitalized. Coming towards the fourth risk that we have identified, loan. I can also show you, it is also included here: issue of equity or loan. Whenever loan is taken, it is always a risk that loan has not properly been split between non-current and current portions of the liability. Because this calculation is very complex to do for the management, they might have made an error in the calculation, because of which the current and non-current portions would be misstated. The current and non-current amounts that had to be recorded are misstated. There are errors in them. Let's read forward. Let's try to identify more risks. In November 2014, Green Corporation spent another expense. So basically, they are right now doing another amount is being added into the company. Another transaction is being made by the company in this one. Now remember, whenever there is a transaction, an amount is given to you, there is always a risk there. Always remember, there is 99% chance that there would be a risk there. Let's read it. Green Corporation spent $400,000 on an advertising campaign, and the cafes were opened. So basically, they were opening new cafes in order to make sure that the customers got to know that new cafes being opened within the stores of Green Corporation. Even though that they sell gardening equipments and let's say gardening furniture, but still they are opening cafes from which we will be able to have tea, fruit juices, so on and so forth, coffees and so on and so forth. So they had to advertise them in December 2014. The advertising expenditure has been included within intangible assets and is being amortized over 24 months, as Aiden White expects that the advertising to generate additional revenue for that period of time. Okay, and so basically, Mr. Aiden White is saying that we did an advertising. It costed us $400,000 to advertise these new cafes. And Mr. Aiden White is saying that I am the CEO of the company. I can do whatever I want to do with the financial statements. And I decided that this advertisement expense, $400,000, should be recorded as an intangible asset. Now, what are intangible assets? Intangible assets are also long-term assets, but they are not tangible. You cannot touch them. They are virtual assets. Advertisement is a virtual type of thing. You have already studied IS 38 with an F7. And Mr. Aiden White is saying that we have capitalized this cost as an intangible asset. We have not expensed it out. Because we think that this new advertisement would give us benefit over the next 24 months. So 24 months, 2 years is also the life that we are using to amortize these intangible assets. This is what is written here. This is what I understood, and you should also be able to understand that as a student. My question from you is, when you studied IS 38 within F7, didn't you see a specific line where it was mentioned that internally generated intangible assets, when they have to be capitalized, first of all, they cannot be capitalized. Whenever they have to be capitalized, they have to go through a criteria. The criteria was, first of all, research expense cannot be capitalized. It has to be expensed out. And when we talk about development expenditure, it can be capitalized, but there is a criteria which is known as pirate criteria. For this exam, you don't need to remember every single line item, like what is pirate criteria, what is meant by PIRATE, what is meant by that. No, you don't need to remember that. But what you need to remember is that if advertisement can be capitalized, wouldn't every single company like Nestle, Unilever, Colgate, or the toothpaste companies that you see, the soap companies that you see, they do a lot of advertisements, right? And their main expense, let's talk about Coca-Cola or let's talk about Pepsi. What is their main expense? Within the company, what is their main expense? Do you know every single bottle that you buy, let's say for $5 from the market, a can of Coca-Cola or Pepsi that you buy for $4 or $2 for $3 within the market, that only that can itself and the drink inside, the soda drink inside, only costs Pepsi 0.3 to 0.4 cents. That is the only cost of the company on the can, and it is selling it to you for $4 or $5 within the market. Why? Why are they having such high margins? Because of marketing expense. And if that would have been the case, these companies that do a lot of marketing, they would have no expense, right? Because if this is the case, that advertisement expense is being capitalized as an intangible asset, this means that it is not going to profit and loss. It is being capitalized. No expense is going to profit and loss. This would mean that Pepsi and Coca-Cola would have trillions of dollars of profit. Look at their revenue. It is in billions, close to $1 trillion. They would virtually have the same amount of profit after tax as well. Their major expense would have been taxes. But they record marketing expenses, advertisement as an expense. They never capitalized it. Why? Because IS 38, intangible assets, the criteria states that advertisement cost cannot be capitalized as an intangible asset. It is not considered as an intangible asset. It does not fulfill the criteria of pirate. It does not fulfill the criteria of being capitalized as an intangible asset under the criteria that is given to us under IS 38. But Aiden White has capitalized it. He has already done it. Now, a lot of the students, now you have understood that there is a risk here that this cost should not have been capitalized, where this has been capitalized by Mr. Aiden White. This means that intangible assets are overstated and the expense, the advertisement expense within statement of profit and loss is understated. You have understood this risk, but still majority of the students will write wrong. Why? Because within their answers, they would still create their answers in a past tense, in a future tense. They would state that there is a risk that advertisement expense has been capitalized, because of which intangible assets are overstated and the advertisement expense is understated. The start of their answer would be, there is a risk. No, there is no risk here. Risk means that there is a chance that there might be something wrong. He has already done it. This is wrong. So there is a sure shot misstatement within the financial statements. In this case, there is a sure shot misstatement. My answer will never start from, in this case, when I identify that something has been done wrong. My answer never starts from, there is a risk. Always write, this has been done wrong. There is no risk. Rather, it is sure that the intangible assets are overstated and the relevant expense within statement of profit and loss is understated. It is sure shot. The risk is not existing here. It is sure shot that this is the case. Let's highlight this as well, and we will write it down when we solve our answers. Let's highlight this. Green Corporation spent this amount on advertising and so on and so forth. The advertisement expenditure has been included within intangible assets and is being amortized over 24 months. As Mr. Aiden White expects, the advertisement would generate an additional revenue for that time period up till this point. This is the which number of risk? Fifth number of risks that we have identified. Now, from all the remaining areas, we only need to identify 3 more risks. Don't you think we will be easily be able to do that. Yes, we will be easily able to do that. Still, we have a lot of material remaining from where we can identify risks right now. Remember, writing down the risks within your answers is one of the most easiest thing. Identification is the difficult part because majority of the students identify incorrect things. Example that I gave you of CCG, some of the students may identify this and write this down as a risk. This is not the risk here. Incorrect identification is the primary reason why students fail the audit risk question. Writing down your answers, and if someone has given you exactly how you write down your answers, if you identify the correct risk, you will never fail the audit risk question. If someone has given you the proper method to write down your answer, this is the proper method to write down your risk answer. But identification is the difficult part. Let's move forward. Let's read the question now. In May 2015, Green Corporation received notification that the building authority had received a complaint that the refurbishments had not been performed in accordance with building regulations. So, in every single country around the world, let's forget about third world countries. Let's talk about United Kingdom. Let's talk about Europe. Let's talk about Russia. Let's talk about USA. Whenever you want to build a shop or whenever you want to build a house, you can't simply go buy bricks and start building the house. No, that is not allowed. That can never be done. Rather, you first of all have to take a proper approval from the regulatory authority, the authority that deals with within your city, that deals with house building, construction, that deals with that. You have to take a proper approval from them. They would also let you know, okay, this is how you will construct your shop or your house, and after construction we will come and see whether you have followed our instructions or not. If you haven't followed our instructions, they would penalize you, they would set a fine upon you, and you will have to pay that fine first of all. Only then, after then, you can continue the construction of your house or your shop. Same is the case in this question as well. The question states that Green Corporation received a notification that the building authority received a complaint. So, building authority in their city received a complaint that the refurbishment that they had done to their shops, it was not according to what? According to the building regulations. They had to follow rules, they did not follow it. What is the risk in this case? We will see it later on. We will discuss it later on, but let's read it. The building authority is currently investigating, and if found to be in breach of regulations, Green Corporations would be required to remedy any deficiencies in addition to paying a fine. So, if the building authority finds out, remedy means if the building authority finds out that any kind of errors have been made during the construction, during the refurbishment of these shops, the Green Corporation will have to correct them as well, incur extra cost to correct the errors they have made while building, and they will also have to pay a fine to the building authorities. Now, always remember, whenever, what was the definition of liability? What was the definition of liability? If you haven't even studied IS 37, the standard that deals with liabilities, provision, and so on and so forth, in F7, the standard name is IS 37. I don't recommend you to study it just for the sake of this F8 syllabus. No, don't do that. But let's discuss it. What was the definition of a liability? Liability means a past event that has occurred. What did I say? A past event that has happened because of which you will have to pay. This is known as a liability. Now, what is meant by the word provision? This is the definition of liability. So basically, this means if an event has occurred during the year, even though someone hasn't confirmed to you whether you have to pay them or not, when you record payables, it is a liability, right? It is recorded within current liability. Why do you record it? What was the past event? You buying things from them. You haven't paid them at the moment. If a past event has occurred because of which in the future you will have to pay someone, you have to record an amount as a liability. But what is a provision? Let's come towards provision now. What is meant by the word provision? Provision means, again, a past event has occurred because of which you will have to pay. But in the case of liability, when do you have to pay and how much, the amount you have to pay? Both of these things are confirmed. When you record a liability, both of these things are confirmed. So let's talk about payables, your suppliers. When you buy things from them, it is confirmed that they will tell you you have to pay us after 3 months. After 90 days, you have to pay us. So the timing is confirmed. When you have to pay, it is confirmed. And then the next thing, the amount. How much do you have to pay them? It is also confirmed. So that is why it is known as a liability. But when you only know that a past event has occurred and you will have to pay, but you don't know when will you have to pay, you don't know that. How much will you have to pay? What will be the amount that you will have to pay? You don't know that. But one thing is confirmed, that you will have to pay them. This is known as a provision. This is known as a provision. So closer to the year end, I'll also give you an example regarding this. Closer to the year end, let's talk about the electricity bill. For let's say December is the year end of your company, or December is the year end in your home. 1st of December to 31st of December, you used electricity, you used, let's say, gas, you used many different things. The bill of those things will be received on 1st of January, 2nd of January, 3rd of January. But let's say you are creating an Excel sheet and trying to find out what were your expenses in December. A past event has occurred. You have used the electricity, and you know that you will have to pay it as well. But when will you have to pay? You will only know once you receive the bill. How much will you have to pay? You will only know once you receive the bill. So that is why even in your Excel sheet that your parents would have prepared 10 years ago, when they were writing down what was the expense of this month, what was the income I generated this month, even you in your future life will have to write down your expenses on a piece of paper, so you know where your money is going. You will still write down at the date 31st of December 2025, you will have still written down, I expect that this is the amount of electricity bill that will come according to your experience of your past months. That was what was the bill for November, what was the bill for September. So going backwards, what were the bills? So according to your expectation, you will still write an amount that this might be my expense. When the actual invoice comes in, then you will correct that amount as well. You will correct that amount later on when you receive the actual invoice. This is how companies also do it. For the financial statements as at 31st of December 2024, if it is confirmed that you will have to pay something, but you don't know when you will have to pay it, you don't know the amount that you will have to pay, they record based upon their experiences what is the expected amount that we will have to pay, and they record it as an expense. They record it as a provision, because provision is something that you don't know when you will have to pay, what amount you will have to pay, but it is sure that you will have to pay it. I don't want to repeat it again and again. This is known as a provision. You will have to record it. Whenever there are litigations against the company, whenever there are situations where it is confirmed that the company will have to pay something, even though it is not confirmed that they have to pay or not. Reading this question right now, we cannot confirm whether the company will have to pay a fine or not. It is not confirmed yet, because in this question it is written that it will be told to us whether we have to pay or not after the investigation is complete. Right now, it is not confirmed whether we will have to pay or not. But as an auditor, you know that IS 37 states that if there were four different chances: remote, possible, probable, virtually certain. If a liability falls in any of the below two circumstances, virtually certain or probable, then you have to record a provision against it on an expectation basis. It is completely probable or virtually certain that even though the investigations are being completed, but you know that the company has made a mistake in refurbishing those different shops. You can see those issues that the company has done. You can see the regulations that the company has broken. They have not followed when they were building the equipment. As an auditor, you can see it. You can go to the stores. You can see those issues that the company has done. Then it is probable that even though the investigation is not yet complete, but still the company will have to pay. Even after the investigations, it would be confirmed the company have to pay. In that case, a company has to record a provision against the expected amount they think that they will have to pay. So this is again a risk in this chance that the company may be required to pay in the future because they have broken the laws. And if they are required to pay in the future, a provision must be recorded against it. Again, audit risk means that there is a chance that this might happen. This is why I'm creating this risk. It doesn't mean that it will happen, but as an auditor, this is all your job to create, identify areas where there are chances of risk that the management might not have recorded something. Management might be required under IS 37 to record a provision in this case. But the management has not recorded anything up till now. This is the risk in this case. Now, what will be the auditor's response? How will we explain it further on? We will discuss it when we will be actually writing down our answers. But right now, I'm only explaining every single thing to you, because so that you understand it, you understand how risks are identified within the questions as well, so that it is easier for you to do the remaining questions. Obviously, I'll do more questions of audit risk as well, but this is your first question that you are even seeing in your life of audit risk. A real life scenario is being presented in front of you. So this question is for understanding how risk is done, how risk is identified. So congratulations, by the way, we have identified 6 different areas of risk up till now. This means we only need to identify 2 more areas from this scenario, from this overall question. Let's read forward now. Green Corporation sells a range of tropical plants. All right, so they sell a lot of different tropical plants. Great. In August 2014, Green Corporation began a project to develop new technology for maintaining the correct temperature and humidity in its greenhouses. All right, all right. So basically, they developed a new technology so that the temperature within their greenhouses where the plants are grown, it is perfect for the plant so that it can grow even further. It can grow. It can have a good growth. So this is what the company has done. They have made a new technology. Great. Now, whenever new technology comes to your mind, technology is not something that you can touch. It is an intangible asset, right? Developing something new, development expenditure will be incurred to develop something new. Research expense, whenever some kind of a new technology is being developed. Let's talk about Apple. Every single year, Apple develops a new type of phone. They research on different things, then they develop the first product within the market. This is known as research and development. Every single company in the world has a research and development department. That department's responsibility is to research in the market what type of new product is required, and then they develop the new type of product. IS 38 states that research expense can only be expensed out, it cannot be capitalized. Whereas development expenditure, if it meets the criteria of capitalization under IS 38, then it can be capitalized. But let's read forward right now. The project is expected to be completed in August 2015, so it is not complete yet. And Green Corporation has incurred a cost of $350,000, which are recognized within intangible assets. So all of the cost that was incurred to make this new technology, it has been capitalized as an intangible asset. It has not been expensed out. Yes, obviously they can do it. You might think, yes, sir, that is 100% correct. They can do it, right? The case that we studied about IS 16 property, plant and equipment, whenever a new cost is being capitalized, there is a risk in that case that that cost might have revenue expense which was required to be expensed out. And only capital expense can be capitalized. That is why we created this risk, right? The first risk is the one, the third risk is the one which we created because of this. Same is the case with intangible assets as well. First of all, always look at it whether this all cost can be capitalized or not. Because when we talked about advertisement expense, we said that this cannot be capitalized. Forget about research expense, forget about development expense, forget about the pirate criteria, the recognition criteria. We don't care about that. Advertisement cost cannot be capitalized. It doesn't have to be identified whether this is a research expense, whether this is a development expenditure. Advertisement cost cannot be capitalized. But when a cost is allowed under IS 38 that it can be capitalized, there is always a risk. As an auditor, you will always have to think, if the management has capitalized all of the cost that was incurred, all of the cost has been capitalized, this means that this might contain some research expense as well, because to develop a new kind of product, first research has to be done. There is a risk that $350,000 might have some research expense, and the remaining might have been the development expense. The development expense can be capitalized by the company if it meets the recognition criteria, the pirate criteria. But let's talk about that research expense. All of the cost has been capitalized. This means management might have, I'm saying not 100% sure, I'm saying that management might have also included research expense within this amount and capitalized all of it as an intangible asset as well. This is the Seventh number risk that we have identified in this case, and we will write down about it when we will go to our answer sheet, when we will go to our the word file that I've created for all the different types of answers. I'll write down about it as well. So let me clean this first of all. So basically, from this lecture, you have gained something new. What is the difference between liability and a provision? It was written here. By the way, my first interview within my practical life, it was in KPMG, Pakistan, and the interview was being taken directly by the partner. And the first question the partner asked me was, what is the difference between a provision and a liability? And I was not able to answer that. The partner repeated his question, what is the difference between liability and a provision? I was not able to answer it again because there was no one who taught me in my teaching, like in when I was a student, no one taught me that there is something that is known as a liability, what is the meaning of liability and what is the meaning of a provision. No one taught me. This is the responsibility of a teacher who teaches financial reporting, not the responsibility of an audit teacher. My audit teacher was the best in the world, but it wasn't his responsibility to teach me what is meant by liability, what is meant by provision. But still, I'm not saying that the teacher might not have taught me. He might have taught it to me, but I didn't remember it. But now, because I have told you that this is the difference between liability and a provision, you will remember it for life now. And by the way, right now within the world, this is a very common question that is asked within interviews as well. Whether you are going to an audit firm to give an interview, whether you are going to a company to give an interview as an accountant, as a financial reporting accountant, this question is very common that it would be asked that if invoices haven't been received, what would you record as a liability? Would you even record a liability? Then you will say, no, we will not record a liability, we will record a provision. We are sure that we have to pay something, but we don't know of the amount and we don't know when we will have to pay it. So that is the difference between a provision and a liability. Liability, the amount is confirmed, the timing is confirmed. But when we talk about provision, the amount is not yet confirmed, and when do we have to pay it? This is also not confirmed. The timing of the payment is also not confirmed. Remember it for life, and also remember it for your exam as well, please. Now, moving forward, let's read the final two paragraphs. In May 2015, a flood caused water damage to inventories of plants which had cost of $425,000. A very common scenario that is tested within the exam, and you will see it being repeatedly being asked within audit risk questions. Water damage to property, plant and equipment, or water damage to inventory. Damage to inventory, damage to property, plant and equipment. As a flood came, a thunderstorm came, a tornado came, you will see this in a lot of questions. The response is only one. Let's read it first. The company believes that the plants can still be sold but at a reduced selling price. The company has said it himself. The selling price would be reduced. When in the previous lecture, I was going through this example. I told you that whenever an auditor sees that the price of something is being reduced in the market, their IS2 says, what does IS2 say? IS2 inventory. It states that inventory should be recorded at the lower of cost or NRV. The cost is 425,000. I don't know how many different plants the company may have, but the total cost of all of those plants combined is 425,000. This is the amount that it took the management to make those costs. That is recorded as inventory. But NRV is calculated as selling price. Let me write it down as well. NRV is calculated as selling price minus cost to sell, CTS, cost to sell, is equal to NRV. So if this selling price goes down in the market, the risk is that this would also reduce NRV. And if NRV, when compared with this amount, let's say the NRV in this case is 410,000. I told you the risk is in this case is that the NRV might have reduced lower than the cost, and IS2 states that inventory should be recorded at the lower of cost or NRV. The risk in that case is that the management has not recorded this inventory at the lower of which was NRV. The management has still recorded this inventory at this amount. The correct entry, the entry that management should have recorded is what? 410, 425. The difference is 15,000 difference. Management should have debited expense as 15,000 and credited inventory by 15,000. This would have made sure that inventory comes down to, when the inventory is credited minus 15,000, the inventory's amount would be 410, automatically recorded at the lower, which was 410,000, which was 410,000. And on the other hand, expense would go within statement of profit and loss as an expense shown within the profit and loss. This means whenever you identify that the NRV of something might have reduced lower than the cost, there is automatically a risk that the management might not have recorded those things at NRV. They might have recorded it still at cost, whereas the NRV is below the cost. You simply don't state that management should have recorded it at NRV. No, maybe the NRV, again, I am creating a risk here. I'm not stating that it is 100% sure. Even if the price is reducing, it might not reduce so much that the NRV is below the cost. That can still happen. Let's say you were selling something for $10 in the market, now it is being sold for 9.5. $0.5 reduction in selling price might not create a big difference, which means that NRV might still be above the cost. The things before were being sold for $500,000. Now they are being sold at $490,000. Still, NRV is above the cost. So this means that the inventory should be recorded at cost because it is lower of NRV and cost. Between the NRV, this is the NRV and this is the cost. Between NRV and cost, still the cost is lower of. So management has recorded correctly. I am only creating a risk in this case that the NRV might have been reduced for these plants which are water damaged now, and people may not buy it. The demand may reduce, and because they are damaged, the NRV may be reduced, which would mean that the inventory is overstated within statement of profit and loss, and the expense of writing inventory down because of NRV reduction, that expense might be understated within statement of profit and loss, which the management might not have recorded appropriately. That is the risk that I am creating here as an auditor. Now let me first clean this mess up and identify this risk. This is by the way the 8th number of risk which we have identified from our question. This means that my questions are basically done. I don't need to, as a student within the exam, when I've identified 8 different risks, still I have what remaining? Still I have this paragraph remaining. Still I have these things remaining. Still I have this paragraph remaining as well. So this means at least one risk is something more that I can identify. But as a student who is within the actual exam, doing the exam of AA, I will ignore everything else. I'll simply go towards my answer sheet, start writing every single risk down which I've identified, and then move towards the next question. Complete all of the exam. If I have extra time, only then I'll come back at the end of the exam. If I have time remaining, then I'll come back and I'll remember in my mind that these areas are still remaining. This means I can write down some extra risks within my answer as well. So if I believe that this is wrong, still I will be able to get marks for the extra risks that I write down. Only then do it. As a student, I would simply stop here and move towards the next question. That's it. Now, but right now we are in actual recorded lecture. We are not in an online, we are not right now doing an exam. Let's read forward and let's try to identify how many risks more are we able to identify. The financial statements for the year ending 31st of July 2015 are expected to show a revenue of this much, gross profit of this much, and operating profit of this much. So I can see the previous year revenue was 85.1 million. This year it is 82.2 million. Previous year gross profit was 16.9 million. This year the gross profit is 23.3 million. Previous year the operating profit was 6.3 million. This year the operating profit is 6.3 million. Previous year the operating profit was 9.4 million. Clearly all the calculations have been given to me. I don't need to go back and calculate every single thing here, but still I can calculate how much increase is in the revenue. So 85.1 minus 88.2 million. What is the increase? Let's calculate it. 88.2, 85.1. So let's calculate it. 88 point, apologies, forgot about it, 82.2, 85.1. So 85.1 minus 88.2, what is the increase? $3.1 million is the increase. Overall, I can see that the gross profit is almost increasing by the same amount, 3.1 million increase within revenue. And if there was a reduction within cost of sales, this means the cost of sales is not properly recorded, right? The cost of sales in this case is not properly recorded because revenue is increasing. If I check the percentage of increase, let's calculate it. 85.1 divided by, so 3.1 is the increase, divided by 85.1 multiplied by 100 is equal to, what have I done? 3 point. Okay. So basically 3.6% increase within revenue, which is not a lot. The revenue isn't increasing by a lot. The revenue is fine, completely fine. The thing is that the cost of, now the my concern is correct. That cost of sales would have decreased by so much that the gross profit has increased. And on the other side, when we talked about the net profit, operating profit margin, that was decreasing. This means these expenses increased, whereas cost of sales was decreasing. So my assumption at that time that the management might have incorrectly classified things that should have, expenses that should have been recorded within cost of sales, and they have recorded after gross profit. That might be correct, because of which this expense is decreasing, this profit is decreasing, whereas the gross profit is increasing at the same time. This shouldn't be the case when we hear about the normal financial statements. An increase within gross profit should show an increase within operating profit and net profit as well. That is the 99% of the chance. There are circumstances where this shouldn't be the case, but that is the 99% of the chance that gross profit, net profit, operating profit, if one is showing increase, then the remaining must show also increase. More probably, if gross profit is increasing, the others must also increase at the same time as well. But this is not happening. Again, my concern, which I created, that some of cost of sales expenses that should come before the gross profit might have been recorded. These expenses might have been recorded after the gross profit, because of which the operating profit is decreasing, whereas the gross profit is increasing of the company. So management might have made a classification error in this case. I'm not going to create a risk that the users of the financial statements would see that the gross profit is increasing and operating profit is decreasing, and they may make adverse decision based upon this. No. I'm not going to create that risk. That is known as a business risk. I'm not here as an auditor. I'm not here to create any kind of business risks. The risk that I will create will always relate to financial statements, that there may be error within the financial statements. And why would there be errors within the financial statements? The explanation is again simple. Management may have recorded some of the things that should have been recorded within cost of sales, and management has recorded them within expenses after the gross profit that should have been recorded here. They have recorded them down here, because of which this expense is increasing, and hence the operating profit is decreasing, and the expenses were low here, because of which as compared to the previous year the gross profit jumped so much. So a classification error is the only risk that can be created here. Let's identify it now. Again, I can simply create here, write it down, that this is the ninth number of risk, classification of expenses. This is the ninth number risk that we have created here. Now, can we create a risk directly for receivable days directly without looking at any other thing? No, not right now, because still there is one final paragraph remaining. Let's read it. One final thing that is remaining. We know that in my mind, there is a risk that the receivable bad debts are understated. Receivables amount is increasing by so much that the receivable days has increased as compared to the previous year. Your customers might not be able to pay you back. That is why they are taking a lot of time to pay you back. An example that I gave within the previous lecture was that if you give money to a friend and that friend confirmed to you that I will pay you back after 1 week, but it's been 2 weeks, 3 weeks, you can call him, sit with him, go to his home, but after 2 months, it's been 2 months that he hasn't still pay you back. What would you think as a person? You would still say, yeah, I'm confirmed that I'm not going to get that money back. So you would forget about it. If a normal person is going to forget about it, why isn't the company forgetting about it? This is what accounting says. If your customers are taking longer than the previous year, then the risk is that they will not pay you back. Hence, you should record a bad debt against those customers who will not be able to pay you back, and your receivables are overstated and the bad debt expense is understated. But this is the risk. Sorry, apologies, my mic fell down. This is the risk that I've created just by looking at this calculation. Still, there is one paragraph remaining. Let's read it. Maybe it is related to receivables. Let's read it. Aiden White has told us that increase in the receivable collection period. So basically, he's talking about this. Why are the days increasing? He's now telling us about this. Increase in the receivable collection period to the is related to the absence of the credit controller who has been on long term sick leave since April 2025. Okay, so the job of credit controller is, who is the person who controls the credit. Credit means when you sell something on credit, you actually don't receive the money, but you tell them you will have to pay us back after 6 months. This is known as credit period, and credit controller's job is to control that period. Whenever that period is ending, he has to remind the customers, call the customers, go to their addresses and remind them, please pay us back, otherwise bad things are going to happen to you. Have you seen Stranger Things, by the way? This is what happens within Stranger Things as well. Those people are known as credit controllers. So credit controllers job is to ensure that customers whose time is over, they have to pay us. If the credit controller has been on sick leaves for a long time, companies who bought things from you might believe that, oh, credit controller is not there. This means that we should not pay this company. They would not be able to identify it. And we can see that from the receivable days. This is why the companies aren't paying you. This means that now it's been so long that they may have an idea, what can they do if we don't pay them? They won't be able to do anything. So as a company, you have to follow a standard that says that if your receivable days are increasing and if you have a doubt that some of your customers will not be able to pay, you have to record against them bad debt expenses. Also known, the proper term for bad debt expenses is allowance for receivables must be recorded, because there is a chance that those customers will not be able to pay you back. Hence, allowance should be created for the customers for whom there is a risk that they will not be able to pay you back. Receivables should be reduced and an expense should be recorded within statement of profit and loss. So this is the next risk using both of these things. The next risk is regarding bad debt expense, allowance for receivable, that it is understated and the receivable amount is overstated. Now all of the question is done. We have identified all the risks from the questions, and congratulations as well. Instead of identifying 8 different audit risks, we have identified how many? 10 different audit risks from our question. So we have done good. Now the time is that we move towards our answer sheet and start writing our answers down. Let's do it.